Okay, it is 7 o'clock, so good evening all. Welcome. Tonight I'm going to lecture over Module 3, and there's a lot of material in Module 3, so I want to get to it. But before I do, I'd like to take time at the top of the class to address any and all questions. It's been my experience that if I take questions at the top of the class, it's beneficial for everybody that logs in for two reasons. One, if you have a question, somebody else in class has the same question. So please don't feel like it's a stupid question or like you're taking up time, or don't be bashful. Ask your questions so that we can address them as a group, because somebody else has the same question and it just greatly helps me out to be able to answer them for the benefit of the whole class all at once. And then secondly, I know there's a subset of you in class tonight that will probably drop off after the Q&A period, and that's okay too. So if we can address your primary concern up front, then you can manage your time efficiently tonight and every time we meet. So we met class 1, we went over the syllabus, I lectured briefly, and then we didn't meet last week because we're on an every other week schedule. On the off weeks, I kind of leave you to the support of our YouTube channel and all of the materials that come with the book. So I want to pause and open it up to you all for questions over the syllabus, the curriculum, the My Business Courses channel, the homework, the YouTube channel. It's all yours.
So I just transferred in this class last week. I was just wanting to know how to access the homework.
It's in the syllabus. So check the syllabus. There's a link to what's called the My Business Course website that comes with this book. That'll get you registered. And then as soon as you're registered, you'll log into our class website. And with each module, there's a homework assignment. Click on that homework assignment and you'll get kind of a guided, it's usually problems-based homework. And all the scores are archived there on the site, so you can kind of see how we're doing as we go through the class and play around with that site a little bit, because there's terrific resources by way of video and guided examples too. And then go back and make sure you watch the night 1 lecture. That'll give you more detail on the syllabus and everything.
And where is that available?
That's on the syllabus too.
Okay.
At the very top, there's a link to our class's YouTube page, and all lectures are archived on that YouTube page, along with some other instructional videos that you'll need for the research project and a few other things.
Thank you.
Yep.
For the research project, kind of looking at the syllabus, is the research project something that we should just be working on throughout the semester and building upon that? Is that what we should be doing?
Yeah, that's right. You got it, Zach. There's, at this stage in the class, what you should be doing is gathering all of your source material. So if you go to our YouTube site and you watch the video from last week, so this would be the video over Module 2, there's also a good chunk of that video that guides you through all of the resources available with this class and through UMKC and the library and the Reese-Nichols databases. You need to access each of those. Type in your ticker symbol, type in your company name, maybe type in your CEO's name, and just begin to compile a folder. I mean, if you printed out all these source documents, you probably have a stack that was 2-inch thick, but you're going to put it all in an electronic file folder, and then you'll just begin to slog through it as we go. So here we are, Module 3. In Module 3, you should, this week anyway, you should have your source docs, or almost have them all. And then after class tonight and throughout the next week, you should focus on calculating the return on equity for your company. And we're going to look at return on assets, and we're going to break down those components. and we're going to analyze them across time. So you'd like to see how those stack up for the last 4 or 5 years, maybe more if you have that much history. And then how do those ratios compare to your company's peer group and competitors? You want to be able to compare and contrast. Now, fortunately for you all, if you watched last week's video, I'm not trying to make this challenging for you or difficult for you. I want you to understand how to calculate these ratios, but after you have a good conceptual understanding, I'm also encouraging you to use the great research that's available at your fingertips through these sites. And then as you compile that into a research report, make sure you build a strong works cited page and bibliography so that I can see how you've done your research. But you don't need to do all the heavy lifting yourself. A lot of this has been done. Use it.
Hey, Vern, just a question about the exam in a couple weeks.
Yeah.
I was looking at my notes from the first class. I don't think I had it. I feel like you said, it's around like maybe 35 questions with true, false, and some other stuff. I wonder if you could just give a top line again on the format of the exam.
Yeah, good question. Thanks for asking it, Jim, because next week we'll be offline. We won't meet in real time. So that'll take us through module 4. And after we get through module 4, I'll post the first exam. So we're closing in on it. And you're going to log into My Business Courses website to take the exam. It'll be posted there in module 4. When you take the exam, you'll click on Open Exam and a timer is going to start. And you're going to have 2 hours to take that exam. It's open book, open note, so it has to be timed. It's really the only constraint that keeps you from looking up every answer on the exam through Google. And to get through the exam, which is 40 multiple choice questions, maybe some true, false, probably multiple choice. To get through 40 of those in 2 hours, you're going to have to be moving a little bit. You will not have time to look up the answer to every question. I estimate you'll have time to look up a third of them, maybe. But if your strategy is, oh, well, open book, open note, no problem, I don't have to study for the exam, you're going to fail the exam. Study for the exam. Be ready to take it. Go through every question on the exam. Answer the ones you know, and then circle back to the ones that are a little bit confusing. Try to look those up. That's the best test-taking strategy for that. So when we get there, I'll post the first exam and I'll open a window. And I'll communicate the window of time to the class. So today's the 2nd. Next week will be the 9th. I'll probably open the exam on the 9th or on the 10th. And then you'll have a whole week to take it. Take it anytime you want. Another control mechanism in that exam is that you can't take it with a buddy. And the way that I control for that is by mixing up the questions and making the questions dynamic. So Jim, if you and Zach are sitting side by side taking the exam and you both get to question 4, well, they may read the same, but you're going to have slightly different numbers, which means you'll have slightly different answers, but it's still testing the same conceptual understanding of the material. So it's a good exam. So if you think you're going to take it with a friend, that won't work either.
How would you say would be the best way to study for the exam?
Well, the best way to study is always to start by reading the chapters in advance, doing the homework in advance, showing up to the lecture, asking any questions that you have, following along with the guided examples that come with the course work through the My Business Courses website. But, I've just given you the long form answer to that. When you ask that question, I know most of the people in class would appreciate, how do I hack this class? How do I get an A on the exam with as little effort as possible? So let's see, how would you hack this class? If it were me, I hate to read, so I would almost exclusively focus on the the videos and the homework and the sample exams posted to our Canvas site. So I'd first do the sample exams, then I'd do the homework, and some of you may have had accounting recently. There may be 40, 50, 60% of this class and this material that's a review. So if you feel like you got a good grasp of it after looking at the practice exams and the homework, move on to the material that might be a little more foreign, and you're going to be able to quickly dial in, kind of tune into that frequency, tune into that material by utilizing the videos and guided examples on the My Business Courses website, because it's all chunked out into learning objectives 1, 2, 3, 4, 5. Tonight there's 9 of them. So if you're following along pretty easily, learning objectives 1 through 6, but we get to learning objective number 7 and you're not quite grasping it, or maybe I'm just not doing a good job of explaining it, well, go back to our website, click on that, rewatch it, and that would be the best way to study for the exam.
Is the question has any concept, or it's all more like the homework?
Both. The homework's pretty technical. There'll be a good mix of that. Keep in mind that the exam is multiple choice, so it's not going to require you to do as many calculations. Also mixed in will be conceptual understanding questions. I'd say it's probably a 50-50 mix, just guessing.
Okay, on the Canvas website, your practice test section, there's a zip file that says 5E, and then there's 4E modules 1 through 14 with quiz and solutions. Does that correlate with the edition of the book?
It does. Yeah, I've been teaching this class so long that I'm on my 3rd edition of the book. So we're on the 6th edition. That material will be the most relevant, but the 5th edition has relevant material too, and so does the 4th edition, and they're all just a little bit different from one another, but I still think they're all relevant. And if you want more practice, go back and look at some of those questions. None of the accounting has changed in those editions. When we get a little bit later into the semester, there's some new accounting for leases, so that might not translate. You probably want to stay exclusively to the 6th edition when you're looking at the accounting for leases. But I think that's the only spot in the semester where the accounting has changed in a way that might make the older material irrelevant.
And maybe I need help finding it, but I don't recall seeing practice tests and solutions for the 6th edition on Canvas.
Okay, well, that is a action item for me then. I don't want to take up class time looking for it, so I'm just going to make myself a note to confirm it's out there, okay?
Sounds good.
So when we're purchasing this book online or just purchasing the course access, would we select the no section ID?
No, don't do that. That's going to send you down a rabbit hole, and you're going to have to call customer support to get out of it. The course ID is in the syllabus.
Excellent, thank you.
Okay, we're 15 minutes into the class, and tonight's module 3 lecture is 80 pages long. I won't be able to get to it all, but I will be able to get to most of the highlights. So I'm going to jump in here, give you some guidance as we go and move through profitability analysis and interpretation. Let me see here. I'm going to try to see if I can blow up my screen. Okay. It says you are screen sharing. Can you see my module 3? Somebody give me a thumbs up. Okay,
Yep.
Thank you. Appreciate that. Okay, profitability analysis and interpretation. Let's look at what man. I don't like it when the bullet points come up one at a time. I like to be able to scroll through the slides. Wonder how I turn that off. X out of there. Okay, bear with me here. All right, if you guys, why did I just close the whole class down? No, okay, good. Let me share my screen again. Wouldn't be the first time I had ended a meeting on accident. If that ever happens, just log back in and I'll be here. Okay, with your permission, I'm just going to go from this screen. It looks big enough for me. Is it big enough for everybody else in the class? I don't hear any objections. So, okay, let's talk about return on equity. Tonight's lecture, we're going to look at that in more detail and identify the discrete granular components that create return on equity. Everybody in this class has identified a research project with some company they want to do work on, Cisco or Microsoft or Starbucks or what have you. So if we're looking at, I don't know, Starbucks as a shareholder, what do we want to know? Well, we want to know how much a share costs. That's one of the key pieces of information. But then secondly, we want to know what we get. If you go pay, I don't know what Starbucks is trading at. If you go pay $100 for Starbucks, what do you get in exchange for that? Man, I think I'm going crazy. Usually when I share my screen, I get a green highlighted square around my screen. I'm not seeing that, but you all can see my screen. Is that correct?
Yeah.
Yeah, we can see it.
Okay. All right, I'm gonna trust it. Okay, pretty simple formula for return on equity. We're going to take net income and we're going to divide by average stockholders' equity. And that's going to give us some indication of how profitable Starbucks is. So that's what we get in exchange for the price we pay. We get profit. We get profitability. And return on equity is one of the measures that we as a shareholder can compute to give us some indication of how well the management is running the business and what percentage of their top line revenues they're dropping to the bottom line. So that's a key indicator of company success, and we want to track that closely over time. Here's data for Boston Scientific Corp. You might have noticed that our authors pick a different company with every module. In module 3, it's Boston Scientific. You run their numbers through that same formula, and their return on equity is 21.24%. That's a really good return on equity, considering that most firms in the S&P 500 have ranged from 13 to 15-ish historically, and that's even still a pretty good number. So be mindful of that as you look at what your company's return on equity is. Boston Scientific was number 97 on the S&P 500 list, so they would be right in that sweet spot there. Hello, 2. Learning objective number 2, apply the DuPont disaggregation method. If any of you in this class are studying for the CFA exam, the CFA exam will hit this heavily. The DuPont method is heavily tested, be familiar with that. And I would also expect each of you to use the DuPont method and the disaggregation of ROE in the appendix of your research report. So recall that the research report has an executive summary. That's where all the most important facts are. You're distilling your investment thesis in the most compelling and persuasive way that you can. But then after you work through the executive summary, you have 15 modules in appendix format. So you have an appendix with 15 modules. When you get to module 3, you should have a breakdown of your company's return on equity, just like our authors have laid it out here in this slide deck and in module 3. So when we break down ROE, what we're looking for are the drivers of ROE, and there's really 2. One is an operating focus. How well is the company operating the business? And then secondly, a big driver of return on equity is leverage. As you'll see, return on equity is broken down between return on assets and financial leverage. So if we take return on equity, which equals net income divided by average stockholders' equity, we can break that down further into two components. The first one being return on assets, which is net income over average total assets. And the second one being financial leverage, which is average total assets divided by stockholders' equity. The first component is more of an indication of how efficient the business is. Sometimes that's a tool we can use to assess managers, the talent level of management. The second decision drives return on equity, and it's a big deal. But if your return on equity is rising, and it's rising because the company is taking on more debt, that is this component here. And I, for one, am very hesitant to give management teams credit for driving greater returns on equity simply by taking on more debt. Any jackass can swipe their credit card another time. There's not a lot of skill to drive higher returns on equities with more financial leverage. So be mindful of that when you're listening to your management teams, when you're reading their quarterly commentaries, when you're trying to get a feel for how the business is being run. If you see these shenanigans, if you see management teams taking on more debt and then turning right around and touting their performance to shareholders as if they're the greatest management team in the industry, well, now you're the analyst. Now you can look at these numbers and recognize that, hey, maybe there's something going on here. Okay, this is one of the reasons why in our proxy analysis, good job, by the way, most everybody in class got that turned in, so nice work. And just know, I haven't gotten to grading all of those yet, but just know if you identified how your company management teams got paid and what their incentive comp is linked to, then mission accomplished, you're going to get the points for that. One of the reasons why we do that very first thing in class is we want to know what the likelihood is, what to be on the lookout for when management, I call it playing games with or shenanigans with the accounting, but there's a lot of instances where it's management's job to estimate something, and that's consistent with GAAP. You need an estimate, or there's two different types of accounting treatment, and they're going to have different effects on the financials, and they're going to have different effects on the ratios. One of those ratios might be return on equity. So if anybody in class identified a management team whose incentive comp is linked to return on equity, well, here we are. I think this is the first time in class, and you're going to recognize this as a recurring theme. If your comp is linked to return on equity, one of the best ways to boost return on equity and therefore your compensation is to take on more debt. Well, if you can get paid more by borrowing more, that's pretty cool. And I would expect any CEO or any CFO that was in that circumstance to do exactly that. So we want to be aware that that might happen in the future and just be mindful of that as an analyst. Okay, return on assets. I mentioned this is the operating measure. We're looking at net income divided by total average assets. It's a measure of profitability, focuses on how well a management team is managing their assets. You have an income statement measure and a balance sheet measure, which is a very common ratio. You'll see that throughout the lecture tonight. I think we're dealing with Boston Scientific here again. You plug these numbers into that equation, and remember anybody remember what their return on equity was? We just looked at it a few slides ago. I think it was like 26 or something like that. Well, here
21.24, I think.
28.24. So 21. Okay. Here's their return on assets. Return on equity was 21. The return on assets is only 8.34. What's the difference? Well, we just looked at the difference in the last slide, 2 slides ago. There's only 2 components. Return on assets was 8, this was 21. So the difference has to be, what's 21 minus 8? 15, 14, 13, 14, 13. Somebody help me out. That's a big component of ROE linked to financial leverage. So what's that tell you? Well, that should tell you that this company has a lot of debt on their balance sheet. And anytime you're looking at a company that has a lot of debt on their balance sheet, that adds risk. There's no way to take on more debt without adding risk, because if you find yourself going through another great financial crisis, or if you're in the housing industry when the housing bubble pops, or you're in the tech industry when the tech bubble pops, or there's some other global geopolitical exogenous event and you owe a bunch of debt, it inhibits your ability to manage around that and can push you into bankruptcy. So Boston Scientific and any investor in Boston Scientific needs to be aware of this. If your company has a lot of debt on their balance sheet, that should be a big focus of your semester-long research report. You should be able to explain why they have that debt, what they use the cash to finance, and how those growth initiatives, whether they were joint ventures or M&A activity or new sales force expansion, whatever it was, how they're powering the future earnings of the firm and giving your management team and shareholder base confidence in their ability to pay that debt back on time, on schedule. Draw all of that out in your research report. That's what a good analyst would do. Okay, I hit on all the points on this slide.
Hey, Vern, sorry, real quick. Their financial leverage was 2.5, and then their ROA was 8.3%. So the ROE then.
He added the financial leverage instead of multiplying it. I just noticed that too.
Thank you. Yep. So I was trying to make the point on this slide that there was an outsized effect of this multiplier, and I added them together. But whoever said that very accurately noticed that these two are multiplied together, not added. So if we had an 8 here, the effect was, what'd you say, Jim? 2 point something?
2.5. So I was wondering if you're looking at it from your liabilities and equity, don't you want something that's like, around 2, because that means you're 50-50?
It varies on industry. So
right.
Yeah. 2 could be good, 2 could be
right.
2 could be bad relative to your peers. What are we looking at here? We're looking at Boston Scientific. So we're in the healthcare business, and most of their expenditures are probably going to be on research and development for some of their drugs. Although Boston Scientific has a big presence in, used to be heart stents. Heart stents used to be one of their major lines of businesses, but it's probably been 10 years since I seriously looked at Boston Scientific. At any rate, if you're manufacturing hardware, heart stents, maybe you got some valve replacements, maybe you got some other hardware, you're going to need manufacturing facilities. And if you have manufacturing facilities, there's almost no way to pop those up without a little bit of debt on your balance sheet. And if that debt is collateralized against hard assets, it's less of a risk. So you as the analyst are going to have to dig into that debt a little bit and find out, what was it for? Was it built? Did we take the debt on to build manufacturing facilities and warehouses and buy equipment that got new manufacturing lines producing? Maybe that's a little bit less risky than if we took the debt out on to go out and finance, say in this industry, it might be new drug development, research and development that doesn't pay off, doesn't produce any new drugs.
So as we look at kind of the bar napkin math, and sorry, I know we have a lot to get through. If your ROE is 20,
mm-hmm.
I know it varies industry to industry. I wonder, in terms of telling a story, you're saying you're getting 20% of your return based on what you give, right?
Say that again.
If I'm looking at a return of equity being,
Yeah.
if it's 20 right now,
Yeah.
or you know, I'm just trying to connect the dots here. You're saying for you should expect maybe, it's about a 20% return of all the equity that they get. That's, they're performing that and above that, right?
Yeah. Yeah.
Okay.
Higher is better, generally speaking.
Got it.
Although the return on asset number is what really gets me excited. If this number was 20 and this number was 20, you would have a company with zero debt whatsoever. This ratio would actually be 1 because the ratio of assets to equity would be 1. You can solve for the proportion of the company that equals debt in that instance is 0. And that's indicative of a very strong company because they've never had to take on any debt to grow their business. And they have all of that borrowing capacity, which for a business is like dry powder. Borrowing capacity is like dry powder. So if something does go crazy in the world, use that 2008 example again, you got the global financial crisis. Well, there probably aren't very many of you in class that were around as investors in 2008. Heck, I don't know. But maybe you'll recall who was the business, or where did companies go in 2008 when they needed dry powder?
Banks went to Berkshire Hathaway.
Yeah, okay. I think that was Chad that threw that out there. Exactly right. And all of my clients own at least one share of Berkshire Hathaway. And that ownership entitles them to a shareholder pass every May at the Berkshire Hathaway shareholders meeting. And it's a bucket list event. If any of you ever want to go, let me know. I'll get you a shareholder pass. And you should go because it's really cool. It sounds like something that would be like watching paint dry, right? Because you got these two old codgers up on stage, Warren and his partner Charlie, and they sit at an old card table and they drink Coca-Cola all day long because they own a bunch of Coke shares, and they eat peanut brittle all day long. Well, 1, because they're 90, and 2, because they own See's Candy. And they take questions from the audience for 6 hours straight, and that's it. And they pack this place with 50,000 people. So that should tell you a little something about what you're going to see. You're going to see a show. You can't put 50,000 people anywhere if the show's no good. But they've been doing this long enough, and they got their shtick, and they're just real down to earth about it. So in 2009, I think it was, we went to the Berkshire Hathaway shareholders meeting, and they were talking about all the opportunities they had seen in the landscape as a result of the great financial crisis. And one of the investment opportunities that Buffett had been able to put money into was an investment in Goldman Sachs. And he never would have got the opportunity to invest in Goldman Sachs unless things were going really crazy. And the banking crisis was so significant, he had to actually bail Goldman Sachs out. And he did it with a preferred loan that gave him a bunch of warrants, which warrants are like options to buy Goldman Sachs' stock at a certain price. And it was so great the way he shared this investment with the rest of the crowd. And then this is how he kicked the meeting off with a stopwatch. So the whole stadium's quiet, and all of a sudden you got Buffett up there, and he starts his clock, and it's like tick tock, tick tock, tick tock. And he's like, "You hear that? Every one of those ticks is $800,000. That was the interest rate he got from letting Goldman Sachs borrow from Berkshire Hathaway at the worst of the great financial crisis. So yeah, you're right. This is dry powder. And some investors will tell you that you need a little debt because it allows you to increase your return on equity. But others, like Buffett, say That's not a healthy way to run your business on an ongoing basis. You should have zero debt until the best opportunities come around, and then you have dry powder to actually put that to work on behalf of your shareholders. So at any rate, I think I kind of belabored that point a little bit, but thank you for listening. And I was all the way to learning objective number 3. So let's take a deeper dive into the return on asset side of that equation. Just like return on equity, return on assets breaks down into profit and asset turnover. Asset turnover is a measure of efficiency. So if you want to figure out what your return on assets are, you need to figure out how many dollars worth of revenue is each dollar's worth of assets producing, and then how profitable is that revenue. That's basically what we've just answered here. So sales, asset turnover, sales divided by assets, is answering the question, how many dollars worth of sales does the business generate from every dollar's worth of assets on the balance sheet? And then for every dollar's worth of sales, how much net income do we generate? So net income divided by sales is your profit margin. So you get profit margin times asset turnover will yield return on assets. Now, when we do it that way, we're a little bit of a diagnostician. What we want to know is, okay, return on assets, we just looked at that as a component of return on equity, but we also know that if we see a trend, if return on assets is increasing or return on assets is decreasing, well, let's diagnose that a little bit. What is causing that? And every time we ask the question why, we get a little more insight into the company. And that insight allows us to be a better analyst and ask more informed questions and make better comparisons to our peer group and know the difference between Boston Scientific and Abbott Labs. And when we know the difference between Boston Scientific and Abbott Labs, we can market ourselves as an expert in the medical device space, because now we're going to know the difference between, you know, maybe at the margin a better investment versus a worse investment. Which one of those do we want to own? To answer that question, we have to know what's the difference in their return on assets and what drives that. Star this chart. This would be a great one for you to come back to, and it's seen several times in this lecture. We started with ROE. We disaggregated that into return on assets and financial leverage. Return on assets is broken down into profitability times productivity. And profitability has several different measures. And we'll look at each one of them. But we need to know what the difference between gross margin, operating margin, and net profit margin is. And then specifically, if we determine that return on assets is being driven by an increase in profitability, well, is it gross or net? Because if it's gross, that probably has something to do with how we're pricing our business. Whatever widget it is that we're selling, we probably have good pricing power if it's gross margin that's increasing. But if gross is staying the same and it's operating expense margin that's decreasing, that says a little something about the way management is managing the business. They're being more efficient. They're being more cost conscious. They're generating the same amount of sales with fewer expense dollars going out the door. Well, that's a pretty good thing. And that's something that we want to incentivize management to do. If they can be more efficient in the operations of their business, that's a good thing. So those two things yield a net profit margin. Productivity is similar. We can look at productivity a variety of different ways. On the last slide, we looked at asset turnover. Well, there's lots of different kinds of assets, right? Asset turnover might be caused by accounts receivable turnover. We might be doing a better job of lowering our accounts receivable. And if accounts receivable are going down and we're generating the same amount of sales, you'll see your asset turnover increase, which will increase your return on assets, which will increase your return on equity. Inventory turnover, we might be doing a better job of more efficiently managing our inventory. If we're getting that through our cost of goods sold process quicker, or if we can create just as many widgets with a smaller amount of inventory on hand, that's a good thing. Accounts payable turnover, cash conversion cycle, property, plant, and equipment turnover. In a company the size of Boston Scientific or any company in the S&P 500, you're going to have an executive level vice president over each one of these. I mean, you can make a career out of managing the inventory of a company like Boston Scientific or Apple or Microsoft. You got billions of dollars worth of inventory. If you can just shave a few percentage points off of that on a quarterly basis, well, you can save your company millions of dollars, and I guarantee you somebody's got that job. Same for all of these. Gross profit margin was one of those. I kind of talked a little bit about gross profit margin. If that's the one that you're diagnosing, if that's the margin component that is increasing or decreasing, now it becomes your job as the analyst to ask the question why. And here's some of the answers. If gross margin is, I guess this one is, if it's low or decreasing, it might be on account of competitive intensity has increased. Well, if that's true, then your prices are probably dropping. Product line has lost appeal. So maybe now you're in the fashion industry and something is going out of style. Product costs have increased. Okay, well, that's just kind of typical inflation, happens all the time. Product mix has changed, volume has declined, and fixed costs have not. This is where you need to be asking questions. So this is an industry that pays very well. When you graduate from your degree track at UMKC, if this is of any interest to you whatsoever, you can get paid in this industry. And this is where that skill set really comes into play. You have to have the presence of mind to be able to know and to ask and to understand how these ratios change with different competitive dynamics. And we covered a lot of these in module number 1. We talked about SWOT analysis. We talked about Porter's 5 forces. You really need to understand your competition. How are those dynamics playing off of each other? What's the interplay and how do they relate? And if you can understand all that, then you can do very, very well as a financial analyst. Operating expense margin, I mentioned that just a moment ago. How well are you managing your expenses? Here's a nice chart that just shows that operating expense margin has been declining since 2009 for the S&P 500. Now, generally, companies have been getting more efficient. We have seen a lot of profit margin increases over the last 10 years. And I'm sure some of you have observed by tuning into the nightly news or reading whatever news magazine that you read, that as companies have gotten more profitable over time, that has led to a widening wealth gap, because who, by and large, owns shares of the S&P 500? Well, people with means and money to own those shares. And I think I'm saying something pretty simple here. If you got a bunch of credit card debt, you probably don't own very many shares of companies in the S&P 500. So as profits accrue to people who do, and the richest 1% own the largest share of that, the rich get richer and the poor get poorer, and you have a widening wealth gap. So that's been major news in the last decade as that gap has continued to widen, especially in the United States. And one of the factors at play are low interest rates. Interest rates have been driven down to now the interest rate on the 10-year treasury is 1% or less. Well, as companies pay less interest expense on the debt that they have outstanding, that helps them manage their overall expense threshold. So some of the mechanisms that our government have used to help manage the economy through this crisis have led to this widening wealth gap. But now I have segued from financial statement analysis into political commentary. So that is all I will say about that, because I'm not qualified to talk about politics. Okay, moving on to productivity. Let's look at asset turnover, break that down into working capital turnover ratios. I had already mentioned there's an accounts receivable turnover, inventory turnover, accounts payable turnover. Know what those are, know how to calculate them, look at them for your assigned companies, look at them throughout time, look at them relative to your competitors, and again, draw out those insights. When you put those working capital ratios together, what you're going to notice is that you now have the components of what we call a cash conversion cycle. A cash conversion cycle, having trouble talking tonight, excuse me, is going to tell you how quickly your business turns accounts receivable, actually how quickly your company turns cash into cash. So you go from cash to inventory to sales to accounts receivable to accounts collected. And as you go through that whole cycle, you can just count up the number of days that your cash sits in each of those buckets. And as you count up your number of days, you're going to use these three formulas. And you'll see that the sum total of those equals your cash conversion cycle. Lower is typically better. You can look at the different number of days across different industries. Industry is going to tell you a little bit about how quickly you can turn cash into cash. My favorite example is Apple. And Apple's cash conversion cycle tells you a little something about just how powerful Apple is. And Walmart's the same way. When you get to be a certain size, when you get to be a certain like behemoth like Apple is, companies will compete for your business. And one of the ways that companies compete for your business is by offering more generous and more generous terms. And that shows up in Apple's cash conversion cycle. This is unusual. This is highly unusual. Apple and maybe a handful of other companies can say the same, where they have a negative cash conversion cycle. So what's that mean, negative cash conversion cycle? It means Apple gets paid in real cash terms before they ever even make a sale in their Apple store. And this is how they do it. Their days sales outstanding is 28. So how long does it take to collect on all their sales? Their days inventory outstanding is 9.8. So they're taking their inventory and moving it through their manufacturing process in almost no time. And then their days payable outstanding is 111 days. So Apple is telling all of their suppliers, give me everything I need to make an iPhone today. I'm going to make that iPhone. I'm going to deliver it to the United States. I'm going to make sure it gets in an Apple store. I'm going to give it to one of our Apple geniuses to sell. Somebody's going to come in, buy that iPhone. And when I sell that iPhone, maybe 90 days after you've given me the inventory, I'm going to pay you. And it's actually not even 90 days, it's 111 days. And all of their original equipment manufacturers are saying, yeah, you're going to sell 8 billion iPhones in the next 90 days. That sounds pretty good to us. Here, take our inventory. There aren't very many businesses in the world strong enough to command that type of, that type of generous terms. Okay, here, I'm going to move a little more quickly through some of this material because it's review. Our authors do the same thing with Merck. Review that on your own time. You can break down their ratios. Let's look at property, plant, and equipment turnover. So you can do this with almost every item on the balance sheet, right? Sales is our numerator, and then in the denominator, we're going to put working capital, or we're going to put inventory, or in this case, we put average property, plant, and equipment. And what's that tell us? It tells us how many dollars worth of sales is each dollar's worth of property, plant, and equipment generating. So it tells us how efficient our capital base is. All these dollars that we've put to work in manufacturing facilities or equipment or whatever, all that money we've spent, how efficient is it? That's what a PPE turnover ratio tells us. And in and of itself, if you, I don't know, if this ratio was 2, that would tell you almost nothing. It's only when you look at that ratio across time and relative to the competition that's out there in the marketplace where you really start to draw those insights. And you're going to hear me say that 100 times in this semester. So make sure with all these ratios that you do that. And I'll go back to something I said at the top of the class. Anytime I say, make sure you do that, what I'm really saying is, make sure you go to Morningstar or Thompson One or one of the sites that we have available to us through the Nichols library and look it up, because it's already been done. You don't have to do the heavy lifting in this class. Just find it, grab it, put it in your report, and then cite it. And you're going to be good.
Hey, Vern.
Yeah.
So I did a similar thing to this in Nathan Mott's class last semester with the valuations, and like we used Morningstar and Thompson One.
Cool.
So I guess, would you prefer that we do exactly what you do? Because for example, the company I did, when I read their annual reports and did the calculations, sometimes they didn't match up to Thompson One. So, you know, that could have been partly on me possibly even, but, you know, for the most part, it is pretty well lined out in those line items. So do you think we should double check it, or should we just go with, you know, those sources you've talked about?
Go with the sources I talked about. If you double check it, you may find out that one of those sources is actually in error, but it's probably going to be noted in some footnote that the analyst has taken some liberty with one of the ratios. The information is still going to be what I call directionally correct. It's going to inform you as an analyst how to make the decisions. And I'm more interested in the analytical skill set, what you do with the data, than I am in your ability to calculate the ratios. I mean, the ability to calculate the ratios is a fundamental component of understanding what those ratios mean. But I want the understanding on the back end of this class, after you've handed in those research reports and completed all the homework and done all the exams. I want to impart on you some level of understanding. So that's what I'm after. And I think you can do those with Thompson One ratios. So the test is going to test your ability to calculate the ratios. The research project is built into this whole curriculum as a way to measure your understanding. So yeah, grab those ratios from Morningstar or Thompson One or wherever, use them in your report, and then draw out for me what they mean in the report, would be my advice to you. Okay, I've seen that chart several times now. Let's talk a little bit about financial leverage. Yeah, I gave the example of Berkshire Hathaway and just how important financial leverage is to any business, or rather what an indication of risk it is. So I think that covers most of the major bullet points on the slide, with the exception of times interest earned. And these two ratios kind of go together, because total liabilities to equity is that's a measure of financial leverage. You know, what we want to know is, you know, how much debt do you have relative to how much equity you have? And you can measure how much assets you have relative to how much equity you have. Those are really two different sides of the same coin. They're telling us how indebted the business is. Well, in different time periods, businesses can manage effectively different amounts of total liabilities or debt. And we measure that by times interest earned. I just mentioned a moment ago that interest rates are at historical lows, the 10 years at 1% or less. So you can borrow more money, and you can service that debt better than you could when interest rates were at 6%. If any of you are shopping for a house, or have shopped for a house, or have refinanced your mortgage in the last year, you've probably recognized that. You're shopping for a bigger house because you can afford more because interest rates are cheap. Times interest earned helps us measure how much risk there is in that equation. So we look at earnings. How much is a company earning? before interest and tax, and we divide by interest expense. So the higher that number is, the better. If a company is earning its interest expense, meaning if its interest expenses in round numbers, let's just say $100, and their earnings before interest and tax is 1,000, that makes me feel pretty good. I'm going to sleep well at night thinking that, yeah, they have plenty of earnings to cover any interest expense. If I'm the bank and I see that their interest expense is 100, and I see that their earnings before interest and taxes 110, well, now I'm starting to get a little nervous, because a 10% hit to their earnings means that they might not have enough money to pay me my interest payment. And that doesn't make me sleep well at night at all. So, well, that is just a different way of measuring the risk on a. Okay, let's see here. I don't remember what this slide was. Return on assets is typically under the control of operating managers, while the capital structure decision is not. Accordingly, a common adjustment is made to the numerator of ROA by adding back after-tax net interest expense. So in this little adjustment, the authors are talking about net income plus after-tax net interest expense. So we just looked on the last slide at an equation that gave us earnings before interest and tax. Well, this is before interest, but we're going to add back the tax savings that the company benefits from, keeping in mind that interest is a tax deductible expense. I think it was Zach just a moment ago asking a question about the Thompson 1 data, and my reply was, use it. It's going to be directionally correct. I want to see your analytical skill set. I would apply the same comment to this slide here. Technically, yes, this is probably a more accurate and detailed way of looking at a business's adjusted ROA. But unless you have a huge statutory tax rate or you have a very large interest expense line item, it's probably not going to be super meaningful in the decision that you'll make as an analyst. One of the key factors to being a good analyst is knowing how to put all of this, knowing how to put this whole class, module 1 through module 15, into context, knowing the difference between what's meaningful and what's noise. As you become an analyst and spend years in the field, you're going to teach yourself, you're going to educate yourself on how to very quickly hone in on what makes a difference between a good investment and a bad investment. And that's all about materiality. So yes, this is important, it's accurate, but when you're thinking about materiality, there's probably other things that are going to come into play before something like that adjustment. So I will fast forward through that and go to learning objective number 4. Identify balance sheet operating items and compute net operating assets. Okay. So the DuPont method takes into account the whole balance sheet and the whole income statement. It's a thorough analysis of return on equity, and there's nothing wrong with that. There's a different way to look at it, though, and we're going to talk about that next, and it's called an operating focus, where we're going to look at the return on net operating assets. So operating is the key word there, because with this shift, what we're trying to do is focus exclusively on the operating portion of the business. And so many companies that you're going to be looking at this semester have little side pockets or joint venture activity or non-controlling interest or merger and acquisitions or some other part of the business, some other stepchild or historical division that has been discontinued or otherwise set aside that is no longer considered a core part of the operating business. And maybe someday you're in private equity, or maybe someday you're in mergers and acquisitions. As you survey the landscape, well, you're looking for opportunities to maybe invest capital, or you're looking for opportunities to consolidate vertically across the supply chain. Well, what you're really interested in are those core operations, because if you were to buy a competitor, or if you were to buy that business, after what you're buying are those core assets, and everything else you probably immediately sell away, which adjusts the net purchase price of whatever it was that you paid for the business. So this focus, this operating focus, kind of takes all that into mind and just looks at, you know, what's the return to the operating assets of the business, because that's a way of measuring the going concern. When I was in school, and I don't know if it's just unique to this textbook or not, but when I was in school, when I was taking the CFA exam, and well, really, the first exposure I ever had to this terminology was through this text. So maybe it is unique to this text. But formerly, I had always heard this referred to as the return on invested capital. So invested capital is really just another way of saying operating capital or operating assets. You know, what's invested? What have you put to work? What is actually working for the business? So if any of you in class see that terminology out there in the industry, know those two terms are somewhat interchangeable. We're trying to get at the same core underlying fundamental economic truth with the use of both of those. So as we look at the operating focus, we'll notice that we are going to differentiate non-operating return. So we're going to look at the difference between operating activities and operating assets from non-operating assets and non-operating activities. So non-operating, very similar to the DuPont method, all of the financing stuff we're going to call non-operating, and we're just going to leave it out of the operating return altogether. So the DuPont method broke it down between ROA and financial leverage. ROA would be slightly more consistent with an operating rate of return, although not entirely. Okay, covered all those points. Okay, return on net operating assets, which our authors, I apologize for this. I don't know that there's any great way to get a handle on all of the terminology in this chapter. RNOA, return on net operating assets. NOPAT, net operating profit after tax. NOA, average net operating assets. I just feel like our authors are inundating you with terms here. So probably just rote memorization or dog-earing the right slide will be the best course of action there. But here's our formula. Return on net operating assets equals the net operating profit margin after tax divided by our average net operating assets. So here's another nit that I'll pick. Our authors, you will see them using average net operating assets. And while technically that's correct, because the balance sheet measures a period of time, in practice, what you'll see, and if you're out there on Thompson 1 and you're trying to understand why some of their numbers might not match what you're calculating from the 10K, well, a very common shortcut is not to use the average and just use end of period, because it's easy. You just have to go look at one balance sheet number. And provided that there hasn't been some major merger or acquisition or other big divestiture, you're probably going to be directionally correct. So that shortcut's not going to hurt you at all. But I just give it to you as a heads up. Be mindful of it. Okay, let's talk a little bit about what an operating asset and what an operating liability is. This slide is a nice cheat sheet, but I have found that students in the past have used this slide thinking that it was meant to be something more than a guide. This is a very simplistic example. When you go to look at your 10K filing, you're probably going to see a balance sheet that's much more complex than this. There's a lot more accounts. There's a lot more roll-ups. You're going to see accounts that are not listed here. And you're going to ask yourself the question, well, I don't know if this is an operating account. I don't know if this is a non-operating account. I don't know where to put it. And there may be no easy answer to that. You might have to check the footnotes. You might have to read the 10K to really understand what that account is. And once you understand what that account is, you should be able to also come to an understanding of whether or not it's key to the ongoing operations of the business and therefore should be calculated as an operating asset, or whether you can disregard that as a financing mechanism or otherwise discontinued asset that you should lump into the non-operating category. But there's a little bit of an assessment that's going to need to be done by you as the analyst. So be aware, you might run into that. And when you do, try not to get overwhelmed. Just ask yourself the objective question: what is this line item? What is this account? What does it do? How does it factor into the business? And that will help guide your decision. But if you look at the breakdown here, our operating assets are going to total 20,000. This is probably in millions, so that's probably 20 billion. And they're comprised of everything that you need to run a business. You need accounts receivable. That's a normal operating asset. Inventories, prepaid taxes, other current assets. Oftentimes these are things that show up on every business. Now, cash and cash equivalents. They're calling that a non-operating asset. Well, this is not an exact science. And this is where it gets confusing, right? And this is where I need for you to think a little bit as an analyst. Some level of cash is required for every business to operate. So a de minimis amount of cash is required for every business to operate. But that's not going to change your numbers significantly. Recall that principle of materiality that I mentioned just a few minutes ago. So by and large, the excess cash, which is material and will show up on your balance sheet, any excess cash is a non-operating item. And Apple is the prime example of this. It's gotten a little bit better since Apple started paying a dividend and they made some acquisitions. But here a few years back, oh gosh, I'm going to get the numbers wrong, but they had an incredible amount of cash on their books. Just they were accumulated billions and billions and billions of dollars worth of cash on their balance sheet. And analysts would ask the management team, why do you guys have all this cash? And they never really could come up with a great example for it. They were just accumulating cash. Maybe it's dry powder. Maybe it's the Warren Buffett example. Maybe they're getting ready to buy Microsoft. Maybe they wanted to buy Google. Who knows? And they never had a great example of it. But they weren't putting it to work. So it showed up in the non-operating asset category. Now, what insights does that give you as an analyst? Well, if you separate that out and you call it non-operating, and then you compute a return on operating assets, that's going to give you a much better idea of what Apple's core business returns or how profitable it is. And theoretically, if you had $1 trillion in your bank account, you could go buy Apple for $1 trillion and pocket all that cash. So you wouldn't need it to run the business. And that's the correct way to think about businesses that have excess cash. So moving on down, you can just see that each of these is an example of operating assets. In the same way, when you get down to liabilities, you have operating and non-operating. So dog ear that slide. It's a good one. Familiarize yourself with it, and you'll be needing it as you work through the homework and exams. Okay, this slide just shows the inverse of that, which are the non-operating, and then the appendices. Yeah, same thing. Okay. Learning objective number 5, identify income statement, operating items, and compute net operating profit after tax. Now that we know the difference between an operating asset and an operating liability, we can do the same thing with the income statement. What we're looking at is net operating profit after tax. So that net operating profit breaks down between net operating profit before tax, which is sales less operating expenses, and those are typically both found pretty readily on the income statement, although not always. Sometimes you're going to have to calculate it yourself, and if you do, these are the major components that you're going to be looking for, and those are the components that you typically see. Revenues less cost of goods sold. Most businesses have a selling, general, and administrative expense, wages, advertising, research and development. Businesses need all this stuff. This is all typically a part of operations. Then from that, we're going to subtract the tax on operating profit. And let's look at an example. So in this example, Boston Scientific, they break out that operating income for us. They break out those operating expenses for us. So that's great. We already know what our net operating profit before tax is. It's right there. So in your homework, you should expect the authors to make it just as clear. Same way on the exam. Now, companies have a lot of flexibility when it comes to reporting their accounting numbers, and they don't always use the same terminology, which is one of the biggest challenges with financial statement analysis and investing in general, is that you have to sift through different terminology, and sometimes you have to sift through terminology for a company that's being purposefully vague. If you're having trouble, a lot of trouble, after you've done this a dozen times, like if you're somebody in my position that's been in this industry for 20 years and you're running into these types of challenges with terminology and understanding the difference between an operating asset and a non-operating asset, it could be because management doesn't want you to know the difference. And I've seen that, and it usually is a hallmark of fraud. And I've studied fraud, and it happens. So I mean, if you're beating your head against the wall, don't be hard on yourself, because this stuff's not always easy. Okay. So let's look at that second component, tax on operating profit. When we look at that, we need to recognize that if a company has debt on its balance sheet, I mentioned this already a few slides back, if a company has debt on its balance sheet, then it's paying interest expense. And if it's paying interest expense, then that's subtracted before tax is calculated. Well, that creates an interest tax shield. And we want to add that back to net operating profit after tax. Or rather, that's that component right there. And it breaks down as follows. Tax on operating profit equals the tax expense. That's the easy one that's reported on the income statement. And we're going to add back the tax shield, which is the pre-tax net non-operating expense, which we identified just a moment ago when we were looking at the income statement and identifying non-operating expenses. And we're going to multiply those times the statutory tax rate. And the statutory tax rate is printed in the 10K filing. You're going to be able to see it in one of the schedules in the back of the annual report. And later in the semester, we're going to take a deep dive into what that report looks like and how that's reported. For now, just familiarize yourself with this equation. And when we get there, I'll add some more color. Okay, and you can see what that looks like on Boston Scientific's income statement here. We have the interest expense, which is 241. We're going to subtract the 156 or the other expense to get 85. So this is our non-operating expense line. So I want to go over here. Okay, so then you can plug those numbers into our equation, and we have our tax expense, which was 249, less our non-operating expense, which was 85, and we just identified that 2 slides ago, times our statutory tax rate, which was 22, and that creates an interest tax shield of $19 million. We're going to add that back to our tax expense for a net of 230. Okay. Learning objective 6 of 9. Compute and interpret return on net operating assets. So we just computed net operating assets. In this example, we're going to measure operating returns by taking net operating profit after tax, NOPAT, which we've worked with already, and we're going to divide that by net operating assets, NOA. Here that is calculated for Boston Scientific. Now remember, Boston Scientific's return on net operating assets here is 12.37. Now remember, at the top of the lecture tonight, we calculated return on assets, which was ROA. Return on assets. Anybody recall what that was? Somewhere in the neighborhood of
8.2.
Nice. Yes, somewhere in the neighborhood of 8%. So how do we interpret the difference between return on assets of 8.2% and return on operating assets of 12.37%?
Does that, so with the RNOA, would that be like, so that in this instance, the 12.37% means they're having a higher return on their actual, like you said, assets that are being put to work, whereas return on assets is encompassing like all of their assets that might have more to be like, I don't know, debt owed to them by other companies or whatever else. Like that kind of encompasses like the financing and interest investing activities too.
Love it. Yeah, that's perfect. That's exactly the way that you should be interpreting it as an analyst. This is a good thing. We just made some adjustments. The business is actually more profitable when you look at it this way. These are the true underlying operating assets of the company. They're generating a higher rate of return than what otherwise would be indicated if we just looked at ROA in aggregate. So yes, we're drawing out some additional insights. We have more information to work with here. We can interpret it, just like you said there, Isaiah, and that was well done. And this is going to make for better comparables against our peer group. So one of the reasons why we look at it this way. Okay. Okay, learning objective number 7. Now we're looking at return on net operating assets. Well, just like the return on assets in aggregate, when we look at it relative to operating assets, we can disaggregate that into profitability and turnover. But again, we're only looking at operating assets and operating profitability, but it's the same breakdown. Once you have your return on operating assets, you can break that down into profit margin and asset turnover. Conceptually, this is identical to what we looked at with the DuPont method earlier in the class tonight. The formulas are a little bit different because we're dealing with NOPAT in the numerator and average net operating assets in the denominator, but conceptually this is identical. And just like we gained a little bit of insight when we looked at the two differences between return on assets and return on operating assets, we can also gain little pieces of insight when we look at it this way. So conceptually, that's what I want you to understand. I'm not going to go deep into the examples here. You can do that on your own time since we're kind of running out of time in class tonight. But there are a few more concepts I wanted to hit. So let me. Okay, learning objective number 8, compute and interpret non-operating return. So there were a few assets on our balance sheet that were non-operating. Well, let's take a closer look. I had a thought come to mind there, but I'm not sure it would be helpful, so I'll just hold it. Non-operating return. So here's our ROE. We can present that as our operating return or return on net operating assets, which we just spent the last 20 minutes talking about, plus non-operating return. And here's how you would calculate the non-operating return. We take financial leverage times some term that we call the spread. And the spread is the difference between your return on net operating assets and net NNEP, which is net non-operating expense percent, or net non-operating expense divided by average non-operating obligations. And this is really where the terminology just starts to crush you. And I know it's going to crush you because it crushes me. I have to come back and look at all these terms every time we come back to this chapter, because remember, I learned this a different way. I learned it as return on invested capital. So I think some of this nomenclature is unique to the authors of our textbook. And I know that doesn't help you much when you're out there, trying to understand the same thing, only it's been written by a Morningstar analyst, or it's been written by an analyst at Thompson One, and they may not necessarily be using the same nomenclature. It makes it harder on you, but the benefit is that if you flip back and forth and you can understand the underlying financials that our authors are using versus maybe something else with different nomenclature that the analyst at Thompson One is using, and conflate those two, man, you're going to have a thorough understanding of what's going on here. And that is just going to be a terrific outcome coming out of this class. So my advice here, anytime I stumble, my advice to you is the same as my advice to me, which is to dog-ear that page, make sure that you can come back to it quickly, spend a little bit of extra time with the nomenclature in advance of the exam, and you're going to do okay. Okay, and I'm going to leave that example is really pretty simple. Once you have the terms, then going back through the balance sheet and income statement to identify the terms and plug them into the formula is not a particular challenge. So I'm going to skip lecturing on that and go down here and make sure. Well, there was one more. There it is. Learning objective number 9. Perform vertical and horizontal analysis. And I've mentioned this a couple of times already, but for each of these terms that we've reviewed tonight, every ratio we'll review in class all semester long. The next step is vertical and horizontal analysis. So what is vertical and horizontal analysis? Well, vertical and horizontal analysis involves looking at the same ratio through a cross section of time. So let's go back and see how that ratio has trended over maybe 10 years, and then pull away any insights that might be useful to us. Another way that you can look at vertical and horizontal analysis is as a percentage of net sales or total assets. So if you look at a common size financial statement, you can present it as, you can take every line item on the income statement and calculate it as a percent of sales. So say, accounts receivable. Accounts receivable as a percentage of net sales might be 10%. Maybe it's been 10%. Maybe it goes, if you look at it over the last 10 years, maybe it goes 10, 10, 9, 9, 8, 8, 7, 6. Well, that's a pretty good trend. You're trending in the right direction. Your accounts receivable as a percent of sales is going down over that period. What's driving that? That's the type of analysis that I want to see you do in your research report. And I'm a little bit disappointed in this PowerPoint deck. Our authors don't have a spreadsheet that kind of shows that. So maybe they do in your book. I'll try to see if I can find one and post it, because I know it's out there. But that would be more helpful for our conversation today. You can do the same thing with the balance sheet, only instead of a percent of sales, you can look at everything as a percent of total assets, and that's going to be a good way to look at that too. Okay, limitations of ratio analysis. This is a good slide. It's just a good thing to be aware of, that if you look at a ratio by itself, sometimes that can drive you to faulty conclusions or suboptimal decisions, which is one of the reasons why our authors have the last slide we just looked at in this deck, because you are going to want to take every one of those ratios and look at it through multiple lenses. It's only when you look at those ratios in light of history and in light of the industry and relative to competitors that you're going to be able to make an informed decision. If you just calculate the numbers and you say that number means X, you're very likely to draw the wrong conclusion, which is one of the reasons why our analysis job is so multifaceted. We want to make sure that we look at it through as many different lenses as we possibly can. And that's the main point of slide 85. And that, my friends, is module number 3. So we are right on time. It's 8:28. That gives me 2 minutes to answer any lingering questions or before we wrap it up.
I'm sure that you obviously did not have your clients in any of these options anyways, but I would be curious to hear about your thoughts on the whole GameStop, AMC, BlackBerry debacle. If you can get into it, I understand if you would don't want to get into that, because I know it's kind of a controversial position. But
well, this is what I do. So you just asked me a question that's going to extend class by 30 minutes, which I love. But the rest of the class doesn't have to listen to me pontificate. If you want to drop off, feel free to drop off. You want to hurt my feelings. But
can I ask a question before you guys continue? I'm so sorry to interrupt.
No, yeah,
go ahead.
Ask real questions before we get on GameStop. Ask them. Yeah, no, 100%.
But if you want to record you answering it, I'll totally go back and watch it later. I'm just short on time for tonight. But I was just wondering, is this class usually till 8:30 or 8:15 for future reference?
Oh, I don't know. I thought it was 8:30, but maybe it's 8:15. What's the syllabus say?
The syllabus doesn't have hours on there, but on Pathway, it says it's until 8:15.
Oh, okay. Well then, yeah, I'm sure you're right. I just got it wrong and went to 8:30. I'll try to do better. Thanks, Yasmin.
No worries. And then I just wanted to make sure. So for next week, all we have to do is module 3, get prepared for the exam, and just continuously work on the paper.
You got
Perfect. Thank you so much. And yeah, if you want to record the rest of the convo, I'll definitely listen in
it.
before
Cool.
next time we meet. Have
Yeah.
a good night. I appreciate you.
So that was so much fun to watch. GameStop and Robinhood and these smaller traders putting a short squeeze on the big hedge funds. I just think it's incredible. It's part of me wants to say that the craziness, it alarms me. I'll tell you that the craziness alarms me because we haven't seen anything like that since the late 90s. And this might be before a lot of yours times. I don't remember, but in the late 90s, that was the first time I can ever remember what I call a pump and dump campaign. And it originally took place in the Yahoo message boards. And you had college kids and high school kids buying cheap penny stocks and then going to the Yahoo message boards and pumping them up just so that they could turn around and make a quick profit. So that's what this reminds me of. And, that was the tech bubble, and that was a horrible crash when that bubble popped. So I don't know if this is like that or an indication of that, but that sure is what it reminds me of. And you're right. My clients were not exposed to any of it. So I just kind of took it all as interesting drama to watch. But part of me wants to root these guys on. I don't know. I think about what they're doing conceptually. I certainly, I understand how to put a short squeeze on. So if that's the game, you think you can short squeeze somebody? That's a fun game. I get that. I might play that game, but I certainly wouldn't be an investor in a company like GameStop. I mean, that's, to me, GameStop is just the next Blockbuster, or AMC Theaters. That was another one that was heavily shorted. I mean, when was the last time anybody saw a movie? That's not a business model I'm excited to own right now. So you have a fundamental difference between a short-term investor and a long-term investor. The short-term investors, they're playing a game. They're trying to put a short squeeze on the hedge funds. They are not interested in owning these stocks. Their ticker symbols, they're just ticker symbols. They're just paper. This is just a game. The hedge funds have identified faulty business models, and they have bet against those business models. And that bet in and of itself will probably play out in the long run. Those businesses are probably going to fail. And if you are short those stocks, when those businesses fail, you will probably make money. The challenge is that because there has been a short squeeze, you are going to lose. And when I say lose, I mean these are paper losses. You're going to lose a lot of money before you end up making money. And unfortunately for hedge funds, a lot of them are beholden to their investors. And when they lose money, investors want to make withdrawals. So now those losses, they're no longer paper losses, they're permanent, because in order to meet those withdrawals, the hedge funds actually have to liquidate those positions. So they never get a chance to see those positions ultimately become profitable. And the Robinhood traders of the world just won in that equation. But if it were you and you weren't a hedge fund investor and you weren't subject to other investors and their capital calls, you could potentially just ride out that storm. And I think as a short seller, you'd eventually be right, although it's a painful ride. So that's my take.
Gotcha.
Were you lucky enough to be in on that?
No, I wasn't in on it. I was just kind of like you, watching, just kind of seeing what was going on. I had a couple friends, I was doing homework, and I had a couple friends like blowing up my phone, text me like, "Hey, have you seen what's going on with GameStop?" And I'm just like, GameStop? What do you mean GameStop? Like that business has been irrelevant for a decade. And I get on, I start reading articles and see the stock price is, almost $400, and I'm just like, holy cow. And yeah, it was crazy to watch. Yeah.
It makes for good news. It's interesting for sure.
Yeah.
So wouldn't these hedge funds just be recommending to their clients just hold out, because this is going to be a short-lived game? That's the company's probably going to fail at some point. Just relax. So they don't actually take the actual losses.
That's what I'd be saying. Yeah, that's what I'd be saying if I were one of these hedgies.
That's what threw me off, why everybody was freaking out so bad. It's like, okay, well, we're just not gonna exercise the position at this time. We'll just wait until these kids get bored.
Yeah.
Yeah,
Well,
they're
you
going
have the other
home.
dynamic in there too, which is the margin call. So the custodian,
true.
whoever they're using, most of the hedge funds use Bank of New York Mellon. That's a big custodian for hedge funds. You know, Bank of New York Mellon is going to require them to post margin call capital as that stock moves against them. So they may be forced to liquidate other positions. And if they can't liquidate other positions, then yeah, they got to liquidate the GameStop or the AMC or whatever
That's
the
true.
short squeeze is on. And, you know, it's guaranteed that some of those hedge funds are probably not going to be as adept or flexible as others. And those are the ones that are really going to end up taking the losses. But yeah, if you have the patience and the
Good point.
wherewithal, I sure would be advising all of my shareholders to play the long game and wait it out.
Right. Well, we actually did restrict the margin on those stocks that are being played with right now. They put a restriction on that for the margin. So I didn't think about that until you just said that would be a potential issue.
Yeah, I saw it.
Yeah.
Go ahead.
Yeah.
All right. Well, thanks all. Appreciate your time tonight. Have a good week. Reach out if you need any help. And I'll see you live in a couple weeks, and I'll have some messages for you in the meantime once I get that exam posted. So
Awesome. Thanks, Professor.
take care.
Thank you very much.
Yep.